Monaco and Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. Let's take a look at what happened overnight. Well, positive investor sentiment carried global equity markets higher again as they look ahead to the Jackson Hole Economic Symposium later in the week. In the US, the Nasdaq led all three major stock indices to a higher close as it and the S&P 500 extended their winning streak to 8 consecutive sessions. That's the longest of the year. Nvidia, Alphabet and Tesla led the gains among the Mag 7. Shares of cybersecurity company Palo Alto Networks rose over 3% in extended trade after its forecast fiscal 25 revenue slightly above estimates at more than $9.1 billion. Advanced Micro Devices rose after the chipmaker said it plans to acquire server maker ZT Systems for $4.9 billion to expand its AI portfolio to compete with Nvidia. HP shares slipped as Morgan Stanley downgraded its valuation. B. Riley Financial fell, extending a drop of more than 65% last week, with co-founder and chief executive Bryant Riley offering to buy the bank after it warned of a hit from its investment in vitamin shop owner Franchise Group. And US-listed shares of mining giants Rio Tinto and BHP were boosted by a rising copper price. And this week, investors will have their eyes on quarterly results from Target and also home improvement chain Lowe's. Well, the US leading economic index fell 0.6% month on month in July. That was worse than forecast, although the Conference Board has said the 6-month annual growth rate no longer signals recession ahead. Meanwhile, Minneapolis Fed President Neil Kashkari has said it's appropriate to discuss potentially cutting US interest rates next month because of the possibility of a weakening labour market, saying the balance of risks has shifted, so the debate about potentially cutting rates in September is an appropriate one to have. Treasury yields have eased, the 10 years down to 3.86%, the 2-year at 4.06%, and the US dollar has fallen to a 7-month low as traders await comments from Fed Reserve Chair Chairman Powell this week at Jackson Hole that are expected to signal the US Central Bank will begin cutting interest rates in September. And the Aussie is up around 1% at 67.3 US cents. Now, markets also be watchful of developments out of the Democratic National Convention, which has got underway in Chicago, with Kamala Harris to formally accept the party's nomination for president on Thursday night. Righto, let's get across what is moving those markets. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome back. Great to see you again. I see your note, FOMO, momentum. Look, the investors want to put their cash somewhere, so the equities are certainly benefiting at the moment, aren't they?
Yeah, good morning, Andrew. Yeah, equities are definitely benefiting. Bonds are benefiting too, as you noted. But right now, what we've seen is, two things happened in the last couple of weeks. Investors reminded themselves that buying the dip is a strategy that typically works. They also remembered that trend following and momentum chasing is a strategy that's worked a lot recently. So they bought the dip, they chased the momentum, and off we go in a relatively quiet period, because it is end of summer here. You're starting to get into back to school and some other stuff. Let's see though if Chairman Powell, throws a monkey wrench into things.
Well, yeah. What do you think we're likely to hear out of Jackson Hole? Is he going to give much signalling there as to what their move is going to be in September?
Here's the crazy part. He's already signaled that they're thinking about cutting rates in September. So someone like Neil Kashkari, who you just referenced, is getting on board. I think the market's already. He basically led us at the last FOMC meeting to expect 25 basis points, but of course he says 25. The market hears 50. he says maybe every other meeting. The market says we're going to get every meeting. And so I my concern is that we get a recalibration because he's not going to come out any more bullish than where the market already is, or more dovish, I should say, I guess, than where the market already is. So what if he simply says, you know what, we're thinking about 25 basis points. It's not a foregone conclusion. And if we get your 25 basis points, we're going to wait a little bit and then we'll see how things go. And maybe again, we'll think about it in November or December even. That's not necessarily what the base case is for the market here. Somehow we've gotten ourselves into another situation where we expect both an economy weak enough to justify aggressive rate cuts, but yet somehow still strong enough to justify the earnings growth that's being priced in. Remember, we had that situation earlier in the year, and it was resolved by the economy strengthening dramatically. So it's not, but in the meantime, we've gotten ourselves into good news is good news and bad news is bad news because the rate cuts are already priced in. So if you've already priced in all your rate cuts, you need the good news. Let's see if the economy cooperates. We'll find out more, in the coming 30 days when we get inflation numbers, the PCE deflator, and jobs report at the first Friday in September.
Yeah, so what your expectation then, you will hear from Jay Powell emphasising that point that if there is a need to cut hard, it's obviously because you're seeing a weakening economy, whereas obviously less so if they're seeing that resilience in the economy.
Yeah, I mean the market changed tack a little bit after the weak job numbers. A couple weeks ago, first Friday in August. And it was somehow the labor market's weakening. There were some temporary factors involving hurricanes in Texas and things like that affected the numbers a bit. We'll see if those were temporary factors. That's another risk to some extent. Let's see if he takes a wait and see approach about that. But again, the market has been ahead of the Fed for much of the year. Most of the biggest portions of the rallies occurred when the market had sort of backed off a lot of rate cut expectations because they were happy about the economy. I think we're back to sort of that conundrum now where somehow we're expecting both. And I have a feeling Powell is going to remind us that you get one or you get the other. You get a good economy or you get aggressive rate cuts. Remember, 2 years ago when Powell shocked the market, because I looked this up recently, what the reason he disappointed the market was they were expecting a Fed pivot 2 years ago. We're still expecting a Fed pivot. So, at that point, he raised rates several percentage points higher. At this point, there's almost no likelihood of that. But again, the market always hopes for something dramatic from him. And this has typically been the speech where he's recalibrated things because he's speaking without an audience. He's speaking, well, to a global audience, but he's speaking basically standing at a podium and in front of a mountain in the middle of a prairie instead of a room full of reporters or an audience. And I think he's generally a friendly and somewhat conciliatory guy in person, and so he softens his message. I think if he wants to give a sterner message, this is his opportunity. And my fear is if he takes that opportunity, the market is not pricing that in at all.
All right, well, you just mentioned that word fear then. Steve, how then appropriately do you position for, well, I guess different possibilities there, but perhaps, if you're going to be a little more hawkish sounding from Jay Powell?
Is right back to where it was before all the hijinks started and carry trades, et cetera. To be fair, that's the S&P and Nasdaq are back up to where they were, basically flirting with all-time highs. We're about a percentage point below a new high in the S&P yet again. But remember what VIX is. It's not specifically a fear gauge. It's not designed that way. It's not set up that way. It reflects the market's best expectation for volatility in the S&P 500 over the coming 30-day period. And what the market is telling you now is they don't expect very much volatility over the next 30 days. Problem is, I outlined some of the things that cause volatility, actually not all of them, because we have Powell's speech on Friday. We have NVIDIA earnings on a week from Wednesday. We have the jobs numbers on September 6th. We have CPI and PPI the following week. And guess what? The September Fed meeting is also now in that 30-day window. So somehow the market is pricing in ongoing calm or at least showing very little demand for hedges right now, which is the other thing that VIX reflects, is just sort of the supply and demand for volatility protection. Um, it seems to me that it's that we're at a level where I'd rather be buying VIX than selling VIX right now aggressively.
Lots to watch, of course. Clearly, what Jay Powell has to say at the end of the week as we head into September. All important decision making right there. Steve, thanks for talking us through it. We'll catch you next week. Thanks for joining us from Interactive Brokers.
Thanks so much, Andrew. Talk to you soon.
All right, let's check the local market, where we're expected to go. Well, given we've seen those rally continuing on global markets overnight, that's how we're likely to open. SPI futures there up almost 0.5%. Stay with us because the open is just a couple of minutes away.